Thanks everybody for being here. My name's Gavin Fillmore. I'm the Chief Revenue Officer here at Tidal, which is honored, quite frankly, to have YieldMax on the platform as an amazing partner and certainly one of our largest growth stories to date. Now, I think what's special is a room like this is generally filled with, RIAs, wealth managers, allocators to product, and we basically don't have that in the room. And we don't have that in the room because what drove this success was, quite frankly, folks like you who have supported our product, supported our story, and got that message out there. And we see this as the innovation in the ETF industry. Product's great, but without support, the product will not get in front of allocators. And clearly, we are here less than 2 years later with $3.5 billion in assets and a community around those assets that is excited about the product and the story. And I believe, Adrian, right? Yep. You were the first video that really we at least saw and said, wow, this is amazing. This gentleman in Canada, if I'm right, did a video and like the next day was 5x volume, right? We could see it, we could touch it, we felt it. And that story kept kind of going and snowballing up until this point. So we made a conscious decision to bring this room together and really invite you to partake in our success. And quite frankly, you should all be proud of it. So thank you. I would like to start there. So with that, we'll keep things kind of loose and fun because this is not a traditional event. So hopefully everybody feels like they can interact and hopefully feel informal in one of the most formal rooms I've ever been in. So, it's hard to avoid. But with that, I'll hand it over to my amazing partner, Mike, who will host a panel that should be nice and light. Right, Mike?
Sounds good. Thank you.
Cool.
Thank you very much, Gavin. I'm so excited for today. I've been looking forward to this for months, and I'm so glad we got everybody together. I was just doing an interview with Corey, and the appreciation we have for the community of do-it-yourselfers and individuals who do their own homework and look for that financial independence, look for the income, and actually like peel back J's and mix trades and see what we're doing. It makes me so proud and so excited to see the next level of ETF growth. So I'm Mike Venuto. I'm the co-founder and CIO of Tidal Financial Group. Tidal's a platform that helps ETFs launch and grow. We service about 150 ETFs today, somewhere between $16 and $17 billion. That number baffles me, but it's exciting too. So it's our job to build all the infrastructure and get this out there and work with great partners like Jay and Chris and all these great people. And it's our job to service the community. I do love that we have something now that we can go directly to that community with. But with that comes questions, there's misinformation, there's all kinds of things where people get excited, and we want to make sure that we have panels of great people who live in this world and do these things to answer a bunch of questions. So that's kind of the idea of this first panel. We're going to talk about trading options ETFs, but we're also going to dive deep into how they're being used and how they're constructed and how the processes work and try and dispel directly from the J's mouth. So we're going to try and go about 30, 40 minutes, then try and get some Q&A in here. And then the next panel is going to be about growing your influence, right? We want to help you guys as well. So Jay, I just gave my intro. We'll go down the line. For those who don't know who Jay is.
I think if you don't know me, then I'm not sure why you're here. But I will quickly go through this. By the way, I couldn't say enough great things about Mike. What Mike, undersold his presence in the ETF community, 20 plus years, multiple businesses he's been involved in. So Mike really is a veteran of the space. I'm glad to be able to partner with Mike. So thank you for all the work on that, Mike. I don't think you get enough thanks, by the way.
That's all good.
You're doing wonderful stuff. So thank you.
You guys keep buying. That's thanks enough.
Right. So I'm Jay Petrocelli, CEO, founder of Zega Financial. We are the sub-advisor on the YieldMax funds. Myself and my team do the actual trades, pick the strikes. Some of you may question why we pick strikes. I'm pointing to Mark over there. I'm just teasing you, Mark. We love you. Mick, Mark's got a question for you about the Tesla strike to 17.5 in November, he asked me today. I didn't know how to answer that one. No, really, this has just been great. Like, I feel so much worth and acceptance from the people in this room. So thank you for all the support. And with that, I will pass it on to Manuel.
Thank you, Jay. Thank you, Matt. And I'm representing Ramos Capital Group, and I've been in the industry for over 3 decades. I look young, but I'm not, okay? So I started when I was 19, by the way. I graduated in Mexico, practiced in Mexico, came to the United States, and I find out that the Hispanic community was underserved in 1989. That's when I started in Hollywood, became the financial advisor back then of big celebrities, getting on radio, getting news. We started writing papers, newspapers, and magazines and stuff like that, and we became, and that's what I know, the pioneers in the United States of financial services in the country. And what we're doing here basically just to bring a different type of flavor. You know, our Hispanic community is not underserved anymore because they had me, thank God, for over 3 decades on radio, daily shows. Tomorrow I have 4 hours, economics, politics, and of course we're going to be talking about ETFs, and that's part of my practice as portfolio manager, designing, constructing, engineering, and using the fundamentals of value investing. I love it. I love it. And when they ask me a question, you know, why should I use the ETFs from Zega Financial and Jay, I have it on my show, by the way, it's very simple. You know, that enhances total return. And that's something that we're going to be talking about today.
Absolutely.
Really thank you again, the title and Zega Financial. And I know my wife, my future wife, is recording this, and I just want to say that we're representing the Hispanic community in the United States of America. Thank you.
Yeah, thanks. So my name is Adrian. I run a YouTube channel called Passive Income Investing with my lovely wife, Erica, which is right there. So our channel focuses on really educating retail investors mostly about income-oriented investing, which of course includes option ETFs like YieldMax. So I just want to say thank you to Tidal for inviting me. I feel very special to be in this amazing place, the bastion of freedom. So I can't wait to discuss how these ETFs really enhance portfolios to really generate income, and which the goal is, of course, to reach financial freedom as soon as possible, and these products do help with that.
And my name is Jason Relke. I am the head of institutional sales at Citadel Securities. Everything that these guys have just described is all kind of at the front end of the ETF construct and what's going on. We're like the last line of defense when it's time to start trading the options that are embedded in these ETFs. We provide block liquidity for the trading partners that we establish over the years. Gavin and I have known each other for 15 plus years, and that's how the relationship has started. And our goal is to consistently make sure that the guys at Zega are looking at their trades and thinking about the different constructs, times to roll, helping them actually implement the trade in the market, providing liquidity to get the best pricing, frankly, which obviously then gets put right back into the performance of the ETF.
All right, so we got through the intros. We're going to get right into the meat of it. I'm going to start with Jay. Just basically give kind of the history of YieldMax. Like, how did we get here?
Yeah,
what do they do?
For sure, yeah. And actually, I have to give a lot of credit to Gavin, who Chief Revenue Officer, started out, calls me one day and said, Jay, what if we could do yield on, could you sell calls on Berkshire Hathaway? And I think that was an idea you and Gavin had kicked around. I was like, sure, we could sell like weekly calls, but it's like, it's 5%, you're capping the upside. I'm not sure if that's worth it, but we could look at ARK and Tesla, and maybe we could generate 90% yields. And all of a sudden, the wheels started turning, and a lot of discussions, and really the partnership between Gavin and I and that product development, I think, grew from there. So it was really idea, talk to a practitioner, and I think we're able to kind of come up with this very first version of YieldMax through Tesla and the ARK fund.
Yeah, and what's interesting, and I've talked to some of you about this today, is this kind of thing wasn't possible 3 years ago, right? The regulators, this is actually a time where regulation changed to the benefit of our industry. So when that regulation changed, you saw the floodgates open, and most people went for, let's do 2 times, let's do 1.5 times, let's do negative this on single stocks. the real innovation of YieldMax was looking at if you could do something with derivatives and single stocks, what is it that investors really want? Do they need another product to allow them to 2x something today, or do they need something that sells vol and distributes income? So to that end, I want to go to Manny, because you are an actual practitioner. If you maybe tell us a little bit about how you use them for your network of advisors and the people that you speak to, community that you speak to.
I think income, it is a fundamental part of the total return, as everybody knows that. And when we construct in a portfolio by using our engineering finance and the architectural finance, we're always looking for an opportunity to not only minimize volatility or risk, but enhancing the metrics and the efficiencies of the portfolio. When our investors, for example, they're looking for a strategy or modeling in where they can bring their assets, either retirements or they want to enhance their income, we always ask the question, and I feel that it's the same thing for any community, because the Hispanics, the first thing they say, how can I make a lot of money with less risk? And I said, it's very simple. Just let's get into principle of investing, As a value investor, I feel very comfortable by using income strategies from your ETFs, Jay. Again, because it provides another sense of margin of safety. If I'm looking already a margin of safety by selecting great companies, individual companies, and ETFs, which is not easy to find value inside of that because the mix of and how an ETF is constructed, we find the way how to really get into value investing in an ETF. Set aside of mutual funds, ETFs, individuals, and then enhancing again the income. When we have an income yield per se of 30, 40%, and I already have, let's say 20% margin of safety, I'm adding additional layer of protection. Instead of it being 10% or 40%, we can go even 100% of that. Margin of safety, long-term investment. So that's one of the things that I use a lot in terms of my practice fundamentally in constructing a portfolio. But I think if I can say that the investors are looking for something is diversification, low cost of what is called the cost effectiveness through the ETF, which is enhance, the returns of the portfolio. And then we have the tax efficiency. That's a no-brainer. Since I find out that ETF, the way it's structured, it has this tax efficiency, I said it has to be part of my strategy because I'm a libertarian economist. And I'm looking for freedom for not only for myself and my practice, for my investors too. So we have those type of elements that are consistent in our strategies. The low cost, tax efficiency, diversification, and then we have an opportunity of investing, to maximize in different sectors and opportunities. So again, by adding the additional yield to all these benefits of an ETF, definitely, to me, it's a must, man.
All right, so you're my pitch man going forward. Adriano, kind of similar question for you, but it's a little different audience. How do they look at it? How do they use it?
Yeah. So my community is mostly made up of retail investors, everyday people just trying to make it, trying to become financially independent, or using it for their retirement. Reason number one, reason number two, reason number three is income, right? But under that umbrella, there are several ways you could actually use these products, which is a great thing. So whether it's allocating a 5, 10, 15% allocation just to boost the overall yield of a portfolio, because when you're making yields north of 20, 30, even 40, 50%, you don't actually have to add too much to really boost the overall yield of your portfolio. And of course, income is very important if you're a retiree, if you need that cash flow. So cash flow, income, definitely the number one reason. How you use it or how much you allocate is really up to you. Second reason is, for lack of a better term, really laziness, to be honest with you, because as someone, when you want to retire, when you want to be financially free, you don't want to spend hours and hours in front of your computer writing your own covered calls, generating your income. To be honest, I don't even have options trading enabled in my broker account. That's how much just looking at options chains gives me a headache. I'd rather leave it to the professionals here. So, I mean, just getting a product where you know this is professionally managed by somebody who's very, very reliable, who's been in the game for a long time, actually wrote a book on options, is very comforting. So reason number 2 is flexibility. Also because this is why, another reason why I love these products, they actually give out all the income. So there's other income-oriented products out there that use options, they'll hold some income back. I say, you know what, let me decide what to do with it. So some people just put the drip on, they reinvest it. Some people reinvest that income into other funds like index funds. So another reason why the community loves these types of funds is they have full flexibility of what to do with that income. Either spend it, pay your mortgage, pay your bills, reinvest it in something else. Then there's other investors who also like buying them to hedge their current stocks, right? So they'll have Tesla, they'll buy the YieldMax Tesla just to hedge a little bit, get some of that income. So main reason for sure is income, but there's several reasons under that umbrella like I described.
That's very thoughtful. I'm going to go to Jason now. I teased him. He's the one with institutional in his title here. And, you know, we've really been talking a lot about a different audience, the retail audience. I'm curious, Citadel Securities looking at a room full of investors that are figuring this out on their own. But at the end of the day, you still got to do the pipes, right? So how do you guys think about this?
Yeah, I mean, the liquidity still has to exist in the options itself. And I appreciate you bringing up the fact that everybody can do their own buy right? I mean, it's not like it's buying an underlying asset, it's selling a call against it. I didn't want Jay to get mad at me if I brought it up, so I'm glad you broke the ice there. But the word institutional, all it means is that we're facing larger pools of money as opposed to retail individuals. And that's the business that I work in at Citadel Securities. Citadel Securities also has an arm that has the retail brokerage houses as their customer and has infrastructure built to handle smaller retail type trades all day, every day, and they are interacting with a significant amount of order flow. The reason that doing it with these pools and why we are interacting with it is there's just a tremendous amount of liquidity in the U.S. options market right now. I've been doing this for probably close to 27 years, and the idea of going to a fund manager, let alone a financial advisor, or let alone an individual investor, and get them to sell calls or sell any option, like sell an option 10 years ago, it was like, oh my God, that's so risky, right? And everybody would run from it. And now you can't get managers to stop selling premium. Like it's the advent of dailies and weeklies, dailies on indexes, weeklies on single stocks has just created an opportunity for a lot of liquidity to be provided, which has introduced the idea of fund managers using it, which to your point of regulation to enable actively managed ETFs to exist has made that blossom too. And it all kind of feeds on itself. Like the amount of demand generates more modeling and capability to trade more. I mean, NVIDIA options yesterday traded 10.6 million contracts.
How much of that was Mick?
Lesser percentage by the day. I mean, it's really incredible. I mean, OCC cleared options were greater than 60 million contracts. Last year, we averaged 43 million contracts a day. I mean, that's outrageous volume. So the technology's enabled it. The attractiveness has enabled it. The products and the building of the products and the marketing of the products in different channels has enabled it. And it all feeds on itself in some capacity. So the institutional side of things, it's facing larger assets of money, but we all benefit from that. If you look at other geographical regions around the world, the European options market is nowhere near where we are. The Canadian options market's nowhere near where we are. And all of that is a function of the retail liquidity that's coming into the market. And it's not the big bad market maker making money off of everybody. It's the two-way nature of the flow has created deeper, and the electronification. I mean, let's be clear, the electronification of the markets. And the last thing I'll say, the centrally cleared OCC clearing, like one spot. Europe, each exchange has its clearing houses. That bifurcation makes it all a much more difficult thing to do. So all of that adds up to put us in a situation where this ecosystem has grown dramatically and probably doesn't have too many constraints on it, frankly.
Yeah, so I love this. We just kind of covered the investor, right? But it's interesting. It seems like this options market and its explosion of volume, it reminds me a little bit of crypto, that retail got to it before the advisors and before the institutions. But because this is such a regulated market, these options, you do have the pipes set up and the mechanics of the traditional institutions, but they're serving retail instead of the advisors. I know very few advisors that trade options on their own. Honestly, if they do them, they often hire Jay to do it for their companies, right? Or they end up calling us and saying, let's build an ETF. So we've talked a good bit about the investors. I do want to move to the mechanics, and I'm going to stick with Jason on these mechanics of how this stuff works. Just what's different here, right? Like creation, redemption, anything that stands out as being really different when we're talking about single stock option-based derivative product. Like, this is all pretty new. Are your pipes being tripped up at all here, or Citadel's on top of it?
So I think I'll speak more towards the market in general. The create redeem function, the actual the construction of an ETF is absolutely not my area of expertise. The options market is theoretically where I'm an expert, but I still continually learn things about it every day, and it's evolving faster than anybody can frankly keep up with. I touched a bit on the electronification. I think that the speed with which things can trade, not just in the options themselves, but in the underlying equities, the depth of the markets and the electronification of that has made it easier for a lot of things to grow. I don't think that there's been any trip-ups. I mean, I know during market bifurcation and during COVID, when exchanges closed, the volume didn't really miss a beat. If anything, it accelerated. And some individual houses had difficulty, but the exchanges closed and everything kept on going, and we didn't close trading for any days. I mean, we went through, you can have all the stress tests and theoretical chances at doing things in a technology environment, but we went through the single biggest stress test any market could probably withstand, right? Shortage of, a technology blackout or some sort of an electrical thing going away. We rely heavily on that now.
It's funny, we had Juneteenth 2 days ago. I don't know I know some of you out there in the community remember it because you guys came after us hard, but last year, Tesla had a delay on the dividend because Juneteenth was a new holiday and the pipes didn't figure it out. Had nothing to do with us. It had to do with data feeds. When we were not allowed to really put out a tweet saying, hey, this wasn't us, but that's what actually caused it. You notice it didn't happen this year, right? We got through Juneteenth. I say that because that's the only hiccup I've seen in a market that has grown exponentially so quickly, and it's just interesting to hold it up there.
I have a follow-up question for Jason on structure. So one of the things that you provide, right, is you are helping us fill our trades, right? When we send you 40, 50,000 contracts at a pop in these single stock names, right? I mean, that's volume that, coming in a single package is your expertise, right? How to manage through that. Have you seen a change on the other side of those trades versus, talk a little bit, because I get the question from the communities all the time, like, how much more of this can you really do? And I know with partners like you, I've never really worried about that, right? So tell us a little bit about the other side of that trade, what you guys hold in-house, what you do with that, what you lay off. Maybe a little clarity there would be helpful.
So again, I'll speak specifically to us. We lay off very little. The concept of laying off is somebody interacts with Mick and the Zega trading team, and then they syndicate the risk into other risk and liquidity providers. We tend to maintain, in most instances, keep that all in-house. So we lay off very little. The constraints on ability to continue to grow, I think as long as you stay around names that have actively traded underlyings, like The options market, the irony is, the options market has grossly outstripped, it provides significantly more liquidity than it should based upon the amount of underlying shares that trade. And the reason that is you've got delta components, you've got potential to pair risk off. I buy a bunch of options from you, potentially I can sell them to somebody else, like in either big pieces or small pieces. That doesn't happen all that often. But you bubble all the risk up into some sort of a top line level risk limits, and you control your risk at the top line, and then focus in on the kind of individual names as the risk gets a little funky at certain spots. But I think the liquidity of the underlying shares is probably the key component. I don't know how everybody does it, but we don't really do that much trading around the position, frankly. It's a weekly situation where the strike is going to be moved in some capacity, and if you sell us a 20 delta option that then becomes a 1 delta option, we've got to trade equity against it most likely. And then if you come in to cover that 1 delta option or selling a 20 delta option again, that we've got to be creative and work with you guys to minimize the amount of impact that's going to have, again, with the idea being you want to maximize your performance. And we want to be there to help and have that conversation and make sure that the performance is there.
All right, so staying on the mechanics, I'm going to go to one of my favorite things about ETFs, which is transparency. And Adriano, I love, he'll look at our positions, dissect it, tell us what we've done right, wrong. I'm just curious, what do you think of that? Like as the preferred vehicle of the transparency of these ETFs?
Well, I mean, the transparency is nothing short of incredible. I mean, I've interviewed many fund managers on my channel, and one of the most reoccurring comments I get when Jay comes on, which I think 3 or 4 times he's come on now, is just the level of honesty, transparency, and most importantly, consistency, because he goes on other channels as well. Shout out to my fellow YouTubers and influencers there. And one of the comments I keep getting is, look, he's literally saying the same thing everywhere. So
I'm so boring. It's the same.
No, it's good. It's a good boring.
Shake it up. Oh no, keep it. Okay.
It's a good boring. We appreciate it. So like I was saying before, we're retail investors. I'm a lazy investor. I don't want to write my own calls, but it doesn't mean I don't want to know what's going on or what the fund manager is doing. So the website is really good because you have, as far as I know, it's very unique. The YieldMax website, you could actually see the trades. And it's very clear in the prospectus. We're selling weekly calls, 5% out of the money, up to 5% of the money. So it's very important for retail investors because, like I said, we want to know we don't want to do it. We don't want to do the work, but we want to know what's going on. So the level of transparency, consistency, and what these funds have delivered has been nothing short of incredible, to be honest.
All right, so Jay, on the mechanics, I'm going to go to you. Just for the record, kind of give the YieldMax 101, the short side, the long side, the pairing together concepts, the iron condor that we keep hearing about.
So everybody has heard the description of YieldMax. Adrian just touched on it, right? The synthetic long, essentially we're long, and then we sell calls 0 to 15% out of the money. Typically, it lands at 5%. Great. Everybody here is familiar with that tactic. What is new now, which is what you're alluding to, is the fact now we have long and short, or I'd say bullish and bearish, inverse ETFs. And so the pairing of that is starting to become a little interesting. That was always our hope, that people would understand that, hey, having an inverse can, limit some risk, but we're essentially creating, and I'm going to thank Max for straightening me out on this one, a short strangle, right? A short strangle. So, the market stays in a range and you should generate net positive premium. If it moves dramatically one way or the other, then you could still have the losses. And the dynamic of that is, let's say, for example, Tesla is capped on the upside. So you'll make some money. At some point, you stop making money. We all know that's a standard covered call. But the inverse crash, which is a covered put, continues to lose money as the market goes up, right? So while you have this period where they offset, then there's a period where they're neutral, and then there's a period where actually your net loss occurs. However, putting those two together has been always our hope that folks figure it out. Now I don't have to be so biased on the direction of the underlying. And so the inverses, I believe, are going to be the focus of our next few launches. We haven't announced those yet, so I'd say keep an eye out for that. But I think everyone knows we filed for an inverse coin, which is fiat, and inverse NVIDIA, which is dips, chips and dips, Where's Gavin? I have to give him credit for that one. Did he leave already? We have an inverse index one, actually on the Qs, which is the first time we'll have an index version, Apple and ARK. So I would say keep an eye out for those, and we like the way that that pairing can work in the products together. The mechanics of that, I think everybody will start to see that as they put them together. I think it's an interesting approach. It's what we're trying to do, continue to be innovative.
Right, and I think the key thing, and I've talked to some of you about this, is the direction is your job to figure out, right? Like you're the investors who are choosing it, right? If you think that Tesla is going to go flat for a long time, owning both makes a lot of sense. If you think Tesla's going to go up, own Tesla. If you think Tesla's going to go down, own Crash. There is no set it and forget it and be done with this. You got to continue to do the work. And you guys have chosen to find your own financial independence. A lot of people have historically relied on brokers and advisors to do this for you. They're not getting educated here like you folks are. You guys are doing the work. But if you're going to use the pair, know that you're making a bet that the thing's going sideways. Otherwise, make a bet on what you believe it's going to do. And to that end, I think, Manny, I know you own a number of these. You guys make the decisions, right? On the kinds of names you're looking to own and which ones you want to have the hedge, the income from. You want to talk a little bit about how you've used these in the portfolios?
Right. I think the formulas or the weights that we use, anywhere from 60-40s or 30-70s, all going to depend on the investor's risk. But we design a series of models, from being the most conservative to aggressive, and then we have our own SMA accounts, and we use the democratization of ETFs in terms of distribution, And when I used it in the past, I started building based on closed-end funds, driving some of this income, and then analyzing deeply, going to the scanner and review what's inside. I mean, when I review Jay's strategy, he knows that I had few conversations with him, but we knew basically who was the portfolio manager from his behavioral finance, behavioral economics to, how he reacts and things like that, and watching on his videos. That's what I do basically, Not only the economical or financial part, but it's, how a portfolio manager like myself or Jay, how do we react in a drawdown years like 2022 or even COVID or, going back to the 1997, it was my first one. It was something else, But the thing is, when we use this type of strategies, my target goal as a portfolio manager is to reduce maximum volatility, enhance the efficiency of the portfolio, and with those type of dividends, like you were explaining before, satisfy the needs of the investor. I mean, we supplement those to their Social Security, annuities, and I was one of the big-time annuity players in the United States, and what happened? Then I find the way of building and constructing our own sort of income, and now, thanks to the opportunity of YieldMax, now maximizing the yields, like this is an advertising for you, okay? We're maximizing the yields, but the total return, always for a portfolio manager, we're looking for not only the alphas, but we look for deltas and the other gammas and stuff like that. So thank you for that, Jay.
Well, listen, I would just say Manny put me through my paces, no doubt, on multiple phone calls, multiple digging in. What are you going to do in this situation? What are you going to do in that situation, right? We talked about the tactics.
Right.
You did a lot of research, before you added the funds to the portfolio.
Yeah, and we did it big time, by the way, okay? So in other words, once I feel comfortable with my team and we make the final decision in our own consensus, we don't think about it. I mean, we just move millions of dollars of my strategies into YieldMax, and we're partners, so we're going to take care of a business together.
You got it.
I love that you're doing Greeks now, too, not just Spanish.
All right.
All right, so we've covered the investor base. We've covered the mechanics. I'm going to move to the future, try and get through this in about 5-10 minutes so we can get a few Q&A in here. I'm going to start with Adriano. I've told all of you today, I love hearing from the community what you want to see next. What do you want to see next?
Yeah, well, first of all, the innovation has been great so far. You got the single stocks, you got the bullish one, now you got the inverse ones. My personal favorite one is an all-in-one type. You have the all-in-one as well, so where you don't have to pick and choose. So if you want to get your feet wet, maybe that's maybe a good one. But what I think is probably the next step, in my opinion, and what the community wants to see is probably some type of leveraged option. So just like we don't want to write our own calls, we're kind of lazy, a lot of us retail investors, myself included, I don't want to deal with my broker to take margin and borrow money. I'd rather leave that, again, to the fund manager. So I think adding a little bit of leverage to some of these products could make sense. Doesn't have to be a whole lot. These are actually very popular products on the Canadian market where you have the option of a leveraged option and a non-leveraged option, so you could pick and choose. But just to give you a little bit of that boost, I think it would be a great next step to see in the lineup.
All right. So let's go to Manny. Similar question. I know you've been working on some product development stuff
Right.
with them. What do you think that should come next?
I think Jay's already know what I have in mind on building not only the models but an ETF itself. And since I'm coming from the financial advisory and I'm being in front of a lot of brokers, in fact, I had a presentation of 680 brokers that we get into those. What they need is exactly what we have to bring to the table. Downside protection, no upside limits. And then, diversification, but at the same time, the high yields. I know we can build it. I mean, insurance companies, like I said, they've been doing something similar, but we're going to be better. There's no doubt.
Yeah, Manny gives me the challenge of, Jay, of course we want income, but growth, right? And, well, obviously protection. So wait, you want income growth and protection? Yeah, that's what
Right.
he's asking for.
Right.
We're going to have a good time on that one
Right.
for sure.
The other thing, too, that I will say, just to finalize on this, is the portfolio is well diversified, fund to fund, you got everything there. But I think that if we start looking into companies that are not only corporate America, but outside of the United States, there's great companies, excellent companies that we can bring into the ETF models, and maximize the yields and stuff like that. International, going global, that's another opportunity. We will do it together.
There is definitely global opportunity. We've talked about that one. Yep.
All right, so I'm going to go to Jason on the future. Can this market handle all that's coming? I mean, it's been a tidal wave, hence the title. How much can you guys take?
I think it can. I would be surprised if it couldn't. It's kept up with volumes on a daily basis that would have, caused electrical outages, 15 years ago. The ability to not only trade but clear options. On the clearing side, it's still a little too manual and not automated enough, but we're working on fixing that. But the trading side of it, it's all fairly automated, and I think as long as the exchanges can keep up, like the biggest choke point traditionally was through the data feeds, like getting the number of quotes out, right? The ability to get the information into whether it's a Bloomberg terminal or something on your phone or what have you, within the Opera system was always the choke point. I haven't heard anybody mention that in a really long time, and I don't know if that's because Opera spent a tremendous amount of money on getting their pipes up to speed, but there's no shortage of introductions of additional strikes and maturities and that type of thing. And it always used to be the amount of data that it consumed, and I haven't heard that complaint in a while. So I think that from that perspective, it certainly can keep up. I also think from a capacity point of view, in terms of being able to provide liquidity and make quotes on block trades, speaking to the U.S. market, I mentioned it earlier, going internationally, it's going to be more difficult. Those like European options, single name European options, listings and ability to trade on European underlyings is not maintained anywhere near the pace of growth that we have in the U.S. The one spot that has volumes that are similar to the U.S. is India, actually. And to the best of my knowledge, we don't have a direct institutional presence into trading Indian options, but the volume there has exploded. Asian markets haven't really kept up as much either. I think the underlying or the individual investor motivation is different than it is in the U.S. I think a lot of, in the U.S., if you think about over the past 5 years, the growth of interest in options trading in the retail investor base, it coincides closely with the gaming, the ability to trade sports betting on your phone. It's the ability to cash out of a game, a bet you've made intraday, all of that type of stuff. There's a very similar kind of growth pattern to the two.
Okay. All right, good. I'm going to put it on the record. Citadel's got our back. All right, Jay, I'm giving you the last formal question, and then we'll try and get to the audience. We've had so much happen in such a short amount of time. What are you most excited about? Is it the Ulti-like products? Is it the fund-to-funds? Is it the shorts? Is it just the next names? What are you most excited about in the YieldMax suite?
Yeah, it's actually almost like this realization finally that the investing community is embracing options the way that they are, right? Well, of course, I think we have put out great products, innovative products, and there's so much more on the back burner that if you guys have talked to some of the other people in this room, you may get hints here and there of what's coming. But for me, the thing that's actually most exciting is that the world can see options can be used for long-term investing, that options can be an enhancement. Options are not just speculating on if a stock's going to beat earnings or not and how to profit from that. Yes, of course, that's always the fun thing to watch on Fast Money. But for me, when I started my firm, it was about letting the community know, letting the investing community, there's a better way to invest and we can do it with options. To me, finally seeing that happen is important. Like our advisor business is fine. We've had growth there, but it's this kind of wave, tidal wave, literally, of what's happening in the space that's exciting me the most. The fact that the world is embracing options is number one thing I'm trying to get done, and it's happening. So thank you, Mike.
Wonderful. All right, we got time for one or two questions. Anybody have anything? If not, I've got some ahead of time, so you did. Okay.
So, what can YieldMax or Title or anyone do? Because the average investor knows nothing about options. They're scared of options. Yes, they may invest in YieldMax, but still they know nothing about options. So, how can you guys educate them? Or how can anyone even educate them if they're not? I don't know.
Yeah, I mean, this is a good question, and it's, I was praising regulators earlier for making it easier for us to bring products out like this. They have not made it easier for us to communicate about them. So honestly, the best thing we can do to help educate is go on your shows, right? Because in order to explain this in depth, we have to put so much disclosure on it that nobody will ever read it. So there is this attempt by regulators to protect that often goes the other way. And that's why communities like yours are so important, and why everybody up here is happy to talk to the community and answer questions and explain the things that we've learned investing in these spaces for 30 years. There are good actual non-regulatory bodies like the OCC. They do put out some good stuff. They will help. But even there, they can only go so far, right? Like our country definitely suffers from a lack of financial literacy and education. Right. This stuff should be taught in school. I was talking to our son the other day, and he asked me, how do you know this stuff? Where did they teach this to you? And it's like, they don't teach this to you almost anywhere. So what you folks do is super important to that end. I don't know if any of you want to add to that.
Manny, you do a lot of education. You're like on both sides of this. Maybe
thank you, Mike.
What you do.
Thank you. What we do basically is financial seminars, educational seminars. We came in one following Saturday, and we've been doing it for over 30 years. We have done over 4,000, it's going to be 4,004 seminars in my career. So now we introducing as portfolio manager, and when we bring our investors, we teach them exactly what we do inside of our models, and then, inside of an ETF, what's going on inside. So we provide seminars besides being on radio on a daily basis and I mean on social media. And then I have a great team. I have Baron, I have my wife Lillian that they manage all the call center. They're always in contact with thousands of investors that we have. We created a magazine in Spanish. By compliance, it has to be in English too. And the latest magazine that we structured is about exclusively investment. The ABC, in fact, I did it ABCD ETFs. Thinking about
Smart.
Right.
I like that.
So we're teaching the basics, and I don't expect that the investors are going to learn that. Even though once in a while you find out, and in a seminar, like we have 300, 400 people or 500 people in front of me, and then they ask you questions that are very interesting questions, and that's how I see how the investors communities are growing. So we bring always quality information. I'm more, as an economist, I bring more theory behind that. Like, for example, in my own portfolio, I used 3 theories behind that and then 2 mechanisms, and I'm adding now the YieldMax just to have an enhanced protection into the portfolio. So when you teach people those areas that are tough to understand even for the professional, but you find out a way how to teach them the ABCDE, finally, we said, the community is growing, and we're building, a great portfolio. We maximize every time we have a seminar, we collect millions and millions and millions of dollars. So I don't have any doubts that the community of the YouTubers, and then radio, digital. In fact, we just created our own digital radio live. In fact, today for the same reasons, 24 hours. So I feel very good.
Wow.
I feel
24 hours
great.
of Manny, that's great.
Can you imagine that?
It's a lot.
That's basically what we do.
I love it. I love it.
We invest a lot of resources, in other words. We invest out of our pocket a lot of resources. We put millions of dollars into technology, innovation. We teach, we bring great portfolio managers and strategists to teach the community. Remember this, we don't do things in English. We do it in Spanish. I can hardly speak English, in fact, sometimes, because my mind is remember when I was on the show, I was talking Spanish, and I said, now I want to change my mind into English. But you know what? It's working in all communities because everybody wants to have freedom, financial freedom. To me, an ETF, as a libertarian, it is freedom coming purely from ETF, definitely. And you know what? VLLC, that's exactly what I'm talking about. Viva la libertad, carajo.
I love it. Round of applause for our panel, please.